Stop staring at your next door neighbor while she's at the balcony. She knows that you're doing it and she thinks you're a creep. So if you guys are renting, now we're going to talk about buy and hold and a little bit of house hacking. So with those videos, I want to make you a real estate investor. I want to show you that it's easy and it's not as hard as most of you might think. So please stick at the end of this video. There's a lot of good tips and tricks of how to buy your first property, how to buy your first investment property, so on and so forth. If you like this content, I would appreciate your like, subscribe, and comment. And if not, just continue staring at your next door neighbor, I guess. Okay, what is buy and hold property in investing? This is a property that you're gonna buy and not be looking for sale. You're gonna be actually buying it and holding it. I know it sounds stupid and redundant, but this is what it is. You buy the property and you count on the fact that you're gonna be cash flowing from the property. Or sometimes, in very rare cases, you're gonna be on a minus, so you're gonna be not cash flowing, you're gonna be on a negative, but you know that this area is under development and it's gonna appreciate a lot. So in the future, when the rent increase comes, then you're gonna actually capitalize on that investment and then you're gonna start cash flowing on that property. Or there's other strategies. You might be buying holding for 5 years, 10 years, 20 years, you know, depending on what you want and how much time horizon you have. If you're 20 years old, it's different compared to when you're 60 years old. You don't have that much time horizon, obviously. So basically, depending on that, we're going to look at what areas you're going to buy. We're going to see what cash on cash is, what cash flow is, what cap rate is, what metrics we need to look for in order to buy our property. But first, let's actually see what house hacking is. And house hacking is something that I do. This basically means that you buy your first property or your primary residence. And when you buy your primary residence, you take advantage of some government subsidizations if you want. I personally do not, because they come with limitations and I don't like limitations. And if you take those government subsidizations, you're not going to be able to do the house hacking that I'm going to explain in this video. So as a first-time home buyer, the government allows you to put less than 20% down, which most of you might think that's all you need to put. You can put 3.5% down. So for a $100,000 property, and I know it's not a mansion, it's not someplace nice, because most people, I notice, they want to live in someplace nice, but they don't make enough money and they buy a house they cannot afford and then they get foreclosed on. We don't want to do that. So you buy a house for 150,000, something below the median price for your city or for the neighborhood, and put 3.5% down. Say you buy a $100,000 property, that's $3,500. Let's wait for that guy to pass. What's up, guy? So that's $3,500. Say 3% for closing, which is another $3,000. Then you have inspections that you want to, you know, do on the property. So let's say all you need to do is collect $10,000, and that's that. Now, when you collect $10,000, I mean, sorry, not collect, when you save $10,000 and you find your property, you buy it. Now, aim of buying more than one bedroom, so 2 or 3 bedrooms. Now, I personally, my first property I bought for $112,000, which was a little bit of a deal because the fair price at the time was like $120,000. Now, I'm not going to go into detail because the property has appreciated, but it might have not appreciated. So I bought it just a little bit, what is it, 5% or so discount on the price, but I rented out 2 of the rooms immediately. My mortgage at the time was $850 because I put such a small amount of money down. On 112, I put $3,500. My loan was like 108 or something like that, 109,000. My mortgage was a bit higher, so it was like 800 and something with PMI. Obviously, PMI is private mortgage insurance. This is when you put less than 20% down, the bank wants to insure their money. Basically, it's like another fee that is about 0.5% from the loan amount. It's another fee that is gets tagged on the mortgage, because obviously the bank wants to make sure in case you default, they took their money, which is fair. Obviously, they're giving you a big chunk of money and they need to make money on them. They're into the business of buying and selling money at the end of the day. So I rented 2 of the rooms right away, and I live and still live into the master bedroom. I rented the other 2 rooms for $500 flat. So that includes electricity, includes internet. My internet is $40 a month and my electricity runs about 110. So pretty much I cover the mortgage. I have not paid mortgage in the last 2 years and I own the property for about 2 years. Now after that I did other things with the property. I refied, I cashed out, refied, but I'm going to explain that into a different video where we go through my whole portfolio, like I have 70 properties. But what I want to illustrate here is this is a property that I'm going to buy and hold long term. You can also, and not you can, you should also homestead the property, which means that it deducts $50,000 of its value for tax purposes. For example, I have a similar property, similar price. I pay, I think if I'm not mistaken, I pay $1,300 a year in taxes on the other property, and on this I pay something like, I don't know, 200, 300 a year. I might be lying with the numbers a little bit, but I just want to illustrate how big of a difference does it make. Buy and hold, we're holding for long term because we want to do 1031 exchange in the future, which is for another video. The rules of the game are the following. You can refinance in 6 months or 180 days. You have to be in a possession of the property. Or you can move out and appoint a new primary within a reason. The reason can be have a wife or have a girlfriend, want a bigger place. We're planning on having a kid, even if you don't. We're planning on, abandoning our kid and we want a smaller property. Now I'm just kidding, but any reason. We want to live closer to the beach. We want to live further from the beach. We want to live closer to work. We don't want to live closer to work. Any reason that might be semi-logical, because what you want to do is you want to leave the primary property after 1 year. You have to own it for 365 days, and then you can appoint a new one. So after 1 year, you live into the property, you move into a new one, and because you're going to be appointing a new property as a primary, the banks allow you to put only 5% down. So the first property we bought in, say, 2020, 3.5% down. Now the second property we buy in 2021, we can only put as little as 5% down. Obviously you can put more, but you don't want to put more for various reasons, such as leveraging, such as inflation, and so on and so forth. We're going to talk about the different strategies in another video. It's just too much to cover in 10 minutes or less, guys. Now you live in 2021 in property number 2, you appoint a new primary property in 2022. Now you have 3, then you have 4, then you have 5. And when you reach 5, it's going to be a little bit of a bottleneck with the banks, but all I'm saying is you can do that all the time. Now the property number 1 we left, we're going to rent out, okay? Property number 2, when we leave it, we're going to rent it out. Property number 3, when we go to property number 4, we're going to rent it out, and so on and so forth. This way you're building your portfolio 1 house a year at a time. Now call your local banks and learn about their rules and what they want from you, so you don't get blindsided, because a couple of times I was going to commit mortgage fraud by accident, and I thought it's not a big deal until I realized it's jail time. But anyways, this is house hacking. And buy and hold is a strategy where we buy the property, and on an investment property we can depreciate over 27.5 years the purchase price that we bought the property for. For example, if we buy a property for $275,000, and this is a specific number for illustrative purposes, we can depreciate it over 27.5 years. So 275K divided by 27.5 is 10,000. So each year, say we make $1,000 in rent, just for simplicity. Now for the whole year we made $12,000 in rent money, right? Now we're going to deduct $10,000 because the property depreciates. By law we're allowed to depreciate it. Now that does not mean that the property value depreciated. It's just on paper, because the government wants to incentivize investors to invest into real estate, and this is one of the ways we get incentivized. So that's one thing, depreciation. I think it's about 3.77% a year, or 127.5 a year. You calculate it. Now another thing we get bonus for buy and hold long term is investment properties only, not primary. We get to write off the interest we pay on the loan. We get to write off roof. I'm so stupid. Roof, stove, laundry machine, dryer, washing machine, dishwasher, anything we fix on the property, obviously it's an expense and we get to write it off. Also, mileage that we go to the property and back, that we go to the store to buy stuff for the property and back, this is all things that we can write off. And there's other writes off that maybe I'm going to dedicate another video for taxes. I'm very passionate about taxes and not really paying them, or actually paying my fair share of taxes. I'm very passionate about that. So if we hold the property and then say by 100,000, we sell it for 200,000. So now we owe taxes on that $100,000 difference because this is income to us. So instead of doing that, how about we hold the property for 27.5 years? It's fully depreciated. We cannot depreciate it anymore. Say the property is 200,000. Again, it's just an example. Now we can do something called a 1031 exchange, which we're going to talk in detail in another video. Again, everything is another video, I know. And basically we're going to appoint a new property. So when we sell the first one for 200,000, we buy another property for the same price. Now we say to the government, hey government, I'll catch you later with the taxes because I just invested. I didn't cash out anything. In America, we pay taxes on the money we cash out as an income. We don't pay taxes on debt or if we exchange it, you know, that's an exchange. Now we buy the second property and then you depreciate it for another 27 years and a half. And if you're alive, you do it again. And then you do that with your whole portfolio. And one day you die, eventually, I'm thinking. Then your inheritance, or people who inherit your stuff and your property, it's something called step-up tax basis, which means that they do not owe any taxes on what they inherit. So it's a good way for creating tax-free wealth, and it's a good thing to do for your children or for your nephews or for your children's children and so on and so forth. Or for your next door neighbor. I don't know, whatever you're into, bro. Whatever you're into. We're still friends. Now, how to pick a good property. In the next video, we're going to look at some things like cash on cash return, cap rate, cash flow, and how to pick a good rental property depending on the area. This is it for now, guys. I hope you enjoyed the video. I know it's just laying the groundwork for what is up to come, but if I make a full video, it's going to be 2-hour long, discussing all those things, and we're going to touch on 1031 exchange as well. And that's it for now, guys. I hope you enjoyed. Please like, subscribe, comment, and leave an angry comment. Don't forget the angry comment. See you next time, folks.